Okay, so welcome everyone to COVID-19, Businesses in the Global Economy. So my name is Dina Metter, and I'm the Associate Director at the Wondery, which is Vanderbilt University's Innovation Center. Today, we're going to be talking about cash flow challenges during a crisis. And this is part of a new weekly series that we'll be running every Monday, beginning at this time, so 11 Central. And before we get started and introduce the expert guest that we have with us today, I want to go over a couple of guidelines just to make today's session run effectively. So we really want to hear your thoughts and questions during the presentation. We're going to do this in two different ways. So you're welcome to tap the raise your hand button when you have a question or a thought that you want to contribute, and we'll stop the speakers, and then you can unmute and ask your question. Once you finish asking the question, make sure that you go back on mute. And then the second way is that you can type your question in the chat box, and I'll stop the speakers and ask it for you. I've got a couple colleagues with me today, Michael Dodson and Patrick Baird. They're going to be helping me out with this, so you might also hear from them in the chat. And unless you're asking a question, please go ahead and stay on mute. You're welcome to turn your camera on if that's something you want to do. We are recording today's session, and I will make that recording available on the Wondery's website after the event concludes. So without any further delay, it's my great pleasure to turn this over to Winston Justice, and he's going to introduce today's speakers.
Thank you. Welcome, everyone. Thank you for joining us today. My name is Winston Justice. I'm a vice president at AllianceBernstein, but I'm also an entrepreneur and small business owner. So I understand firsthand how big of an impact this crisis is having on our listeners and our community as a whole. So I'm glad we really got to get together and really discuss. On another note, we at AllianceBernstein are really thrilled to be making Nashville our new global headquarters, and also to be supporting such a amazing investment community. Our sole business is to manage investments for our clients and institutions, but the true purpose of our work is to guide our clients through uncertain times, like the ones we're going through now. And being one of the top investment research firms, this is where our value really comes to life. And I'm so happy to have two of my colleagues here with me from Bernstein. Greg Young, a senior investment strategist out of our Dallas office. He'll be discussing his historical drawdowns and also the global markets as a whole. I'm really happy that he's here on the call, and I'm excited to hear his insights. And then also Richard Weaver. He is a director with our wealth strategies group here at AllianceBernstein. He's been really busy guiding our business owners and navigating them through the new CARES Act. So we're real happy he's on the phone call now, and I'm excited to hear about his insights too as well. I also like to welcome my good friend Amir El Husseini. He is a CEO of the Lodestone Advisory Group here, based here in Nashville, which is a boutique strategic investment management consulting firm. It's been a great honor getting to know him and also his group here. He was the one that spearheaded this webinar to get this all together. So thank you for that. And then finally, our moderator for today's conversation, Dina, the Associate Director of the Vanderbilt Innovation Center here. So thank you, Greg, Richard, Amir, and Dina for all being here. The main purpose of the of this webinar was to help talk through and navigate these uncertain times. So we hope to provide everyone that's on the call with a robust dialogue of our experiences with business owners and how to navigate the current volatile market conditions. So from there, Dina, the floor is yours.
So we're going to, I'm going to turn it over to Amr. I'm going to let you kick us off. I think we're ready to get going.
Thank you, Dina. Thank you, everyone, for joining. Thanks for arranging this and all the help provided. So this is Amr Husseini speaking. I just want to start by recapping what we did in the first session. The first session was a couple of weeks ago, and we introduced basically a number of topics that we will be going through in the next few weeks. The first topic we talked about is what's going on in the world, basically the uncertainty, unpacking pieces of the uncertainty, understanding that this is, it's fine if nobody knows the answer, and it's fine if we keep looking on a day-to-day basis to address some of the challenges our businesses, our investments, our lives are going through. One of the things or the main topics we introduced was the types of recession. What does a recovery look like from historical perspective? We also said that this is the first time we see the event in modern history, in modern financial markets. So we don't know what to predict based on the scale and the depth of that on the economy. We said that the world is as interconnected as ever. And yes, we are looking at the US economy as a main part of the fundamental recovery, but don't forget that we are part of the world and we rely on the world heavily. So if we recover, if we have a stimulus package, it doesn't mean that the rest of the world will recover as quickly. And this is something we talked about very briefly today. I will add some more comments with my colleagues on that. We talked about a couple of case studies, if you remember Uber, and we also talked about Tesla. The Uber case was mostly to address like what does it mean for companies to navigate times like that. We focused very much on the response that they had for the market, what they told the analyst as a company, what the CEO communicated on the cash flows, the prioritization of cash flows versus growth and margins as one of the topics. And then we talked very briefly about how to look inwards into your own company, into your own case, and how to address it. Today, we're going to expand on a lot of these concepts. I will start with the first, just quick overview. We're going to focus on a global economic snapshot. This is something that we will do regularly, just to keep a check on what's going on. In various asset classes, the timelines and the recovery process. How does it look like today? A couple of weeks later, what's going on basically in that space. I will add a few comments on how the US economy is connected to the world, in what sense, just a few numbers that make everyone think as they go through that process within their own company again, and or with their own perspective on investments. We will talk about how this crisis is changing the world. What does it mean for small businesses? We'll introduce very briefly just high-level comments on what's the CARES Act, what's the PPP program, what do they do, how do we look at these. This is not obviously a session to address specific questions on that, but I want everyone on the call to have at least a perspective on where to look into. If you are an investor, if you are an individual, if you are a small business, what are the options, at least for now. And then we will readdress in more depth the cash flow challenges for business. I have a few slides to go through after my colleagues are done presenting on the global economy and everything else. And then we'll wrap it up with key takeaways, and then we'll open probably 15 minutes for Q&A towards the end. I would like to start by inviting Greg/Richard. I think Greg is going to kick it off with a snapshot on the global economy, and we'll take it from there. Greg?
Okay, great. Thank you very much. I want to make sure that everyone can hear me okay?
We can see you and
okay.
Very well. Yeah, excellent.
Excellent. I think, Amir, you've got the slides, so if you'll advance the slide for us, that would be great. So I probably won't go through all of these slides. I'll just try and get a check-in every once in a while to see how we're doing on timing. But I think it's important to set the stage. And let's start where we need to, which is on the medical front. We're all obviously learning more each and every day about COVID-19. It's interesting to look backwards and compare this to some of the more notable epidemics and pandemics that are in a similar vein. Early on, when this was starting to come into the news, one of the most comparisons was to the SARS epidemic back in 2003. However, as you look across these different metrics, the top half of this page dealing with the outbreaks in China, and then on a global basis below that, It looks like the better analog is going to be to the swine flu epidemic that took place in 09 and 10. Obviously, we're still ongoing as far as COVID is concerned, but in terms of the scale, it really looks like that's the better comparison. And probably is at least as good a starting point as any for getting an idea of how long this is likely to last, and in which case we're talking about obviously more than a year. So unfortunately, we're still likely in the early innings of this, but at least this gives us a starting point for comparison. Now, if you'll advance the slide as well. This is, everyone hears about flattening the curve, and I would just quickly comment that this chart was at towards the end of March. It's not the most recent data, but this gives you a sense of the scale of what we're dealing with. I'm not the one, and certainly not a medical expert, to judge when this is going to start to flatten out specifically for the US, but it does give you a sense that what we are experiencing here in this country is unfortunately is kind of setting the precedent for what the rest of the world is experiencing. We're undergoing a significant growth rate, and at least based on the experience of other countries, China sort of take that with a grain of salt perhaps, but in South Korea and Japan and elsewhere, there is an expectation that we're getting close to, we hope, an inflection point where this curve will start to bend down. If you'll take us to the next slide. Now let's sort of shift and talk about this from a market standpoint. Here's the way to think about these circles, and let's look all the way to the right, to the largest circle there. This was going up until the peak of the market. We stopped the data approximately February 19th of this year. And if you look at that pie chart, it's simply asking the question, historically, how many weeks did the market, the S&P 500, go between 20% declines? And the smaller number in that circle, 106 weeks, that's approximately the average amount of time, the average of weeks. Think about that as roughly 2 years, where the markets would experience 20% declines or greater essentially every 2 years. Except that this cycle, at least leading up to February 19th, we'd gone an astounding 573 weeks, basically 11 years, without having experienced technically a 20% decline. So right away that you can see this was the bull market that just ended was an extraordinarily long one. And in some sense, it's reasonable to conclude that we were probably overdue. Of course, you never know exactly what the catalyst is going to be, but it was an extraordinarily long cycle. The next page. And this, when you drill down a little bit more and look at the years that preceded it. So on the left-hand side, this is 2018. You'll notice the months arrayed along the bottom. The middle area is 2019. And then obviously the 3 months to the right with the big red line pointing down, those are the first 3 months of this year. And but for some volatile months in the summer of last year, and then particularly in the fourth quarter of 2018, by and large, this was a pretty stable time period. Now, we came awfully close in the fourth quarter of 2018 to having that 20% decline in the S&P and global markets we did. But that was almost a harbinger, as it were. But then when it arrived in full force towards the end of February, you can see that it exacted a pretty fearsome toll, particularly in the month of March that just concluded. So unfortunately, sort of making up for lost time, the markets, when they took on a head of steam and started to decline, it happened in very rapid fashion. Okay, on the next slide, please. Now, one thing to point out, this is a little bit in the weeds, but what has made this decline, and I think this has amplified the volatility we've seen in the stock market, has been the unusual goings on in the bond markets, particularly in the treasuries market. I think this is sort of very much the safe haven category, and this line is measuring the yield on the 30-year US Treasury as really a representation of a risk-free asset class. And that line declines. It shows that the yield was declining, but we know that interest rates and bond prices move inversely. So you can think of that line moving down where it troughed around March 10th. And consequently, prices going up was a clear sort of classic expectation of what would happen in treasuries and risk-free assets as volatility was starting to pick up in the stock market. But then something unusual happened. You'll notice that that line started to move up very rapidly, sort of a classic V-shaped spike back up. And this was the unusual part of it, because while stock markets were in the midst of a very volatile period of time, we started to see treasuries act unusually because rates were rising and consequently prices falling. There was, for a whole host of reasons, the inability of treasuries to trade during this time. That was a very unusual feature. A lot of it, frankly, having to do with Wall Street and the banks. Simply, their balance sheets were way too full of treasuries, and up until the Fed started to intervene more directly, they had very little ability to take on more treasuries onto their balance sheet, and that started to have a ripple effect across bond markets. Now, the good news is that the Fed's interventions have started to improve this situation, and that would continue. Okay, let's fast forward. And I'm going to skip through a couple of slides just in the interest of time, Amir. If you'll keep going until I tell you to stop. Let's stop here for just 1 second. If you'll go back to that VIX page, please. So a little bit of an eye chart, unfortunately, but this does make an interesting point. This is looking at the VIX. Think about this as a representation of volatility in a stock market. And so as you look along the left hand, the y-axis, the vertical axis, this is measuring the change in the S&P 500, daily change. And then the bottom horizontal x-axis measures the change in the VIX. As you go from left to right, you're increasing in volatility. And on the left-hand scale, as you're moving from top to bottom, the market is declining. So there's a clear upper left to lower right feature here. As markets are declining, typically it coincides with a pickup in volatility. Look at where those most volatile days were in March, right around the 12th and the 16th, were over this period of time, and this goes back for a pretty, all the way back to 1990. Those were the most volatile days that we've seen in the VIX over that period of time, and not surprisingly coincided with pretty substantial declines in the market. So there really was, in many respects, an unprecedented amount of volatility that was going on during the worst part of March. Okay, now if we'll fast forward, keep going.
So, Greg, I want to interrupt you for just a minute. So we had a question come in about what's the VIX?
So the VIX, good question. The VIX is essentially a measure. It's thought of as the volatility measure, but it's measuring the change in futures prices for S&P 500. And so it gives a real-time market-driven indication of how much prices or futures in the futures market for the S&P 500 are moving around. And so it's a very good indication from a market standpoint what the expected level of volatility is, or excuse me, the actual volatility is for the S&P 500. It's not a perfect measure of volatility, but since it is among the most frequently cited and most clearly recognized, it's sort of everyone's go-to explanation for just a measure of overall volatility in the stock market. Okay, let's go ahead a couple more slides. I just want to land on, keep going. And let's stop here, and then I've got one more I want to show you. This little heat map, a frequent question is, what is the market pricing in right now, the stock market pricing in, both in terms of the amount of, earnings decline and sort of an overall valuation level for stocks. So the way to think about this, if you look along the top, it's measuring both the dollar amount of S&P 500 earnings per share, as well as the percentage decrease from last year, from 2019. Where we finished the year, you see all the way to the right, earnings EPS for the S&P was at $175 and was forecasting, until all of this hit, about an 8% level of growth in earnings per share. So now we can interpolate from how much the stock market has declined, essentially what the market is baking in for both an earnings forecast on the top, as well as a judgment on the valuation level, the so-called price to earnings multiple or PE multiple. And so you'll see where we've got that outlined in a box. Towards the end of March, we were down on a peak to trough basis, somewhere around that 30% neighborhood, call it between 27 and 32%. So one way to look at this is that at that level, the market was pricing in about a 15% decline in earnings. And then looking along the left side, somewhere between a 16 and 17 multiple on stocks, right? Remember, we started the year closer to 18, so somewhere in that 16 to 17. Now, another way to be a little bit more precise on this, you could look over just one column to the left. The 32% could also be interpreted as maybe a 20% decline in earnings associated with a 17 multiple. Gives you somewhere in that range, somewhere between 15 and maybe 20% decline in earnings for the year. That's going to be priced somewhere in the 16 to 17 times. Obviously, that's pretty drastic. If we were to go lower than that, or to have the market fall more than it has so far, would have to lead to an even more draconian decline in either earnings or valuation. All right, last chart on the next page, please. So let's try and end on a little bit of a hopeful note. So this gives you some market history, and I'm just going to clear a couple of these lines so you'll have a good way to interpret. We're looking at all of the big bear market sell-offs since World War II. Those dates are arrayed along the left. And then we show the month where the markets reached their bottom, the trough. And then we look at a couple of ways of measure. How long did it take for the market to decline 20%? How much did they go down in total? How many months did it take for the market to get back to that high? And most importantly, what was from the trough, from when the markets bottomed, how much did stocks recover in, let's just call it the first 12 months? In other words, is there an incentive for hanging around after the damage has been done in order to capture some level of return once things start to bottom? So you can look at the very bottom line on this page as the average for all of these. It's probably most instructive to look at the third line from the bottom. This was the 2007 to 2009 global financial crisis. So as that is a comparison, you'll notice that it took 17 months from where the markets peaked in October of 2007 before they bottomed out in March of 2009. During that time, the stock market, the S&P, was down 55% from its peak, and earnings were down a whopping 41%. And it took a long time for markets to climb out of, about 54 months, about 4.5 years. Interestingly, that 40 number tells you that it took quite a while. This didn't happen overnight. It took 40 weeks for the market to lose 20% early in the financial crisis. So this is something that sort of came on gradually. But once things did bottom out in March of 09, in the first 12 months following that, the markets recovered 72%. So it's a very substantial climb out. Now, it still took a while to get back to even, but you can see that most of that return tends to be front loaded. Now look to the very bottom line, and I'll finish my part. If we look at all of the averages, not just the financial crisis, it took normally about 16 months to go from peak to trough. Interestingly, how many weeks, the second column from the right, normally took 40 weeks to decline 20%. We got there this time in 3 weeks. So the most rapid decline in to get to 20% bear market really that we've seen in US history. So pretty extraordinary from that standpoint. Hopefully, because this cycle is still ongoing, it won't take 54 months. The average is more like a little less than 3 years. And the average 12-month return coming out of the bottom is something like 44%. So let's hope that we're somewhere in that 44%, maybe as high as 72% in the first 12 months once we do finally reach a trough. Okay, I feel like I've been taking up most of the airtime, so I'm going to stop there and turn it back to Dina.
Okay, perfect. So with that, let's move on to our next topic. Amer, I think that's you.
Yeah, just a few comments and the question to both Richard and Greg to get it on to the next topic. Last week, one of the items we discussed is I mentioned during the conversation towards the end that if you're looking actively pursuing the bottom, you're never going to find it. And if somebody tells you they know where the bottom is, they're probably misleading you. What you need to be looking for is value versus a bottom that nobody knows how it looks like when it comes and how to get a benefit from that. I noticed also part of your slides that you mentioned if you're out of the market and you miss the top 4 or 5 days, you're losing a big portion of the recovery. I don't know if you're going to address that later, or if Richard is going to do it. I would spend just a couple of minutes talking about these. I find them to be very interesting for everyone.
No, that's fine. And Richard, feel free to chime in if you'd like. If you want to, Amir, if you want to flip through ahead a slide or two, I think we do have that. Let's go forward another one. Keep going one more. There you go. So this is what Amir is referring to. When you look back, this goes back to 1988 through the end of last year, so not including the first 3 months of this year, but over essentially almost a 40-year time horizon. We've had, a 32-year time horizon. If you looked at the S&P 500 and you took all of that period of time and you broke it into 3-year time periods, and you rolled forward and looked at all the average of all of those rolling 3-year time periods, on average over the 3 years, the S&P would generate 10.7% as an annualized return if you were in from the beginning to end on average over those rolling 3-year time periods. However, if for whatever reason you miss the 5 best days, the 5 highest returning days in each one of those 3-year time periods, it had a substantial impact on your average return. Missing the 5 highest days in each 3-year time period took your annual return from close to an 11% down to more like 4% in the stock market, which over that same period of time was very close, if not right in line with what bonds actually returned. So there's a couple of important takeaways from that. First of all, timing. Besides just the impossibility of knowing what the future holds, the penalty for being wrong and missing out on the market's inevitable big days, big up days, can be very, very injurious to your returns. And the other point would be, rather than risk that, you'd just be better off if the psychology is so difficult to deal with. In many cases, investors would have, at least historically, just been better off in bonds and not have to deal with the anxiety of worrying about the ups and downs in the market. Because if you did wind up missing those big days, your returns were going to essentially mirror bonds in the first place.
Thanks, Greg. I will pass it on to Richard to say a few words and to go through his thoughts on the process. I think, Richard, you're going to talk about the recovery, the stimulus package a little bit, and then add some of your notes.
Yes, thank you. And I'm just going to get some of my notes going here. You know, it's interesting because some of the business owners we have there are facing tremendous liquidity crunch. And so I didn't know if it would be helpful to the listeners to, you know, to determine whether or not they had liquidity issues and to speak about the what the government has done in the CARES Act and the Small Business Administration and how they've used the SBA. Would that be helpful to the group?
Yes, definitely.
Yes, definitely.
Okay, so look, the government knows and understands that 47% of you know of the employers in this economy are small business owners, right? 47%. So the question then is, you know, how do we make sure that those business owners survive and do not go out of business? And I'm hearing amazing statistics like already a quarter of small businesses have temporarily shut down, which is sad to hear, but hopefully they'll be implementing, you know, measures to come back on the scene very soon. So the question,
sorry to interrupt, just if you look at the screen, I have a summary of basically the CARES Act, which is the Coronavirus Aid Relief and Economic Security Act, for anyone that doesn't know, and then the PPP highlights, basically, which is the Paycheck Protection Program.
Right.
Like the CARES Act is the overall stimulus package that was, it's more an aid package than stimulus. There's a lot of commentary on that. And then the PPP is basically addressed mostly to small businesses. I have a summary of what they cover, if that helps, but keep going.
Sure. So look, when it boils down to liquidity, right now there are two main lending facilities. The SBA already had an economic injury, a disaster lending facility, and they put this in place before the CARES Act came out when things were going poorly. And you could apply for that on the SBA website. By the way, if you haven't looked at the website, it's just full of good information. And those loans were, up to $2 million you could get, depending on the size of your business, and you could use them for a lot of different aspects of your business. Okay, the CARES Act that came out, helped that lending facility, but also came out with the PPP, as you say, payroll, protection, the Paycheck Protection Program, and that really is to keep people employed. And so what that does is you can actually submit an application. And by the way, this just went into place for this past Friday. So depending on, whether your company or whether you're a sole proprietor, it depends on what date you can submit your application. So April the 3rd, basically companies, sole proprietors, independent operators have to wait a week from now. And what can you apply for? Well, you look at all your payroll costs, and it's just not salary, but it's other things like sick leave and a whole bunch, retirement, all these benefits. And you look at the average over the last year, and you take the average monthly payroll expense, and you multiply that by 2.5 times, and that's what you apply for. Now, some people say, well, that's not enough for us, but that's still covering 2.5 months. Now, the interesting thing is, I mentioned that earlier loan facility, the economic injury disaster loan, that has to be repaid back over time, although you can wait 6 months before you pay. With the payroll protection, the paycheck protection loan, you could actually get that loan forgiven. You're going to say, how is that possible? You can get it forgiven if you prove, once you get the loan, that you have not reduced your employer account when you look at your employers when you get the loan versus the last 12 months, and you've not reduced their salary by more than 25%. If you've done some of that, the loan forgiveness is going to go down in proportion. But if you've kept your employees on the payroll and you apply the loan to payroll expenses plus to keep your lights on, utilities, your rent, etc., you can get pretty much that loan forgiven. And that what you would do is you go back to the bank after 2.5 months and prove that. The interesting thing is, if you don't do that and you want to keep the loan on your books, the loans are for 2 years right now, and the interest rate is 1%. Okay, so that's been very helpful. I want to stop. Any questions on the application and being able to apply for the loans? Either one of those. No?
Dina, any questions so far? Or you want to leave the questions for the last 15 minutes?
I have one question really quick with regard to the last statement. So I, like one of the small and medium-sized enterprises here in Nashville, it's a Little Vermont. The owners are French citizens. And so once I spoke to them this Saturday, they said that once the 20% of the business is owned by the foreigners or more, they don't qualify. So I'm just curious if there will be any reconsideration, because I think, I don't know the statistics, but I would assume that a lot of small and medium-sized businesses are owned by immigrants, by entrepreneurs. So is there any consideration to expand it to holders of working visas who are at this point foreign citizens?
I know it's a very good point, and I've heard that before. And so this is not the last of the act. We anticipate that there are going to be adjustments made as feedback comes, and if it's proven that, as you say, there are a lot of U.S. businesses where people are, still it's foreign owned. It's the 20% number. I've heard some people, that 20% number might be 18% or whatever. But back to your point. They're reconsidering even adding more money to this program. So I would not put it past them to as they hear back. It's a fluid situation, and I understand, but I wouldn't put it past them to make sort of extra provisions for that as well. But I hear your pain. So a lot of those companies, what are they doing? They're having to really internalize, the situation, and on their own books, doing things like, working with the suppliers and postponing payments to suppliers and calling the banks up and sort of deferring mortgage payments, speaking to landlords, et cetera. So I've heard some drastic situations, which I don't necessarily advise, but you've got credit cards drawing down more on the credit cards payments. And so, if there's real estate, maybe trying to get loans. So a lot of businesses that are trying to apply are being forced to really take drastic measures right now to preserve liquidity. But at this point, you're right, more than 20% foreign owned that cannot apply. Are there any other questions on that?
Yeah, Richard, we've got a couple of the questions on the chat as well. One, I have a question on the SBA PPP. How do you think it's been rolled out? I applied for it, but understand that it was very unorganized and banks have struggled to submit the applications online. Have you heard anything about this? And then the second one was broadly, how do you apply? Should you go through the SBA website, or do you have to find an SBA approved lender first and apply through them?
So that's good. The SBA is overwhelmed. So if it's the economic injury disaster loan, that you can go directly. But what they've done initially, the SBA came out and said, we are going to deputize certain banks. But right now, pretty much any financial institution, if it agrees to certain procedures that the SBA has put out, there's a form that the banks have to fill out, they're able to make the loans. So that sounded great. And then I heard the same things that you had heard, that someone who had, for example, a personal account at a bank would not be able to apply for the loan because the bank was only looking first to the businesses they had. So if you didn't have a business deposit, business deposit or the business checking account, you weren't eligible for the loan. So I heard that. So the next thing we did, and we're looking, and the SBA, by the way, publishes a list of all the banks they know that are the biggest lenders here. But the next thing we've been doing is looking at community banks. So you can actually put in on the SBA website a zip code, and they can tell you what the community banks are. So I've been speaking to a few community banks, and they're all willing to do it because you don't necessarily have to have an account with them, even though they will favor those clients first, but they want to do well for any business in the community. They're suddenly overwhelmed. Okay, so that's been a real issue. Another thing you can do, by the way, is I talked about these two loans, the economic injury disaster loan. If you go on and start applying for it, even though you're trying to do the PPP loan as well, and you can get an emergency amount of $10,000 just from applying, and you don't have to necessarily pay that back if they don't accept you. Okay, so that's sort of how you can gain one of the loans first as you're applying for the paycheck loan itself. But you can't have them both outstanding and for payroll. So there's a little bit of that as well. But going back to your original point, it is right now a little bit of a crazy show. We anticipate over the next few days that that's going to lighten up because, as I said earlier, the independent contractors are coming in on next Friday. So the banks are just going to have to, get it together on this. But it is an issue right now. Is there a follow-up, Patrick, on that?
No, that's all we've got from the chat for now. Thanks.
Okay. So look, there are other things that you can do if you're not taking out the PPP loan. You're allowed to defer some of your payroll payments. It's called, let me just double check, the employee retention. That's right, the employee retention tax credit gives you, if you can show how much that your business year upon year has dropped about 50%, you can actually take some credit against your payroll as well. 50% of qualified wages. The problem is if you apply under the CARES Act for the PPP program, you cannot use the credit. Okay, so I see that as a mention up there. Retirement accounts for individuals. If we go to that, I'm thinking also of a business owner that has a retirement account. They've increased the loan amount you can take off a retirement account under the Act to $100,000. Okay, that's kind of interesting. If you have an IRA and you have $100,000 in that, you can actually withdraw that without a penalty, even if you haven't reached, the age where you can withdraw without penalty. no matter what age you are, you can take out $100,000. And if you have to pay tax on that, you can defer the tax over 3 years. But if you put the money back the end of 3 years, if you intend to do so, that's okay. So in a way, you can borrow from your IRA. By the way, as investment managers, we don't necessarily recommend that, because if you're going to be pulling from a market where we feel that, going back to Greg's slides, that there's potential for recovery, and it's like selling. You don't want to necessarily pull out of your accounts. Any questions on retirement accounts?
And Richard, I will say we've got about 2 to 3 more minutes before we have to move on to the next topic.
Okay. All right. So look, I would say that what I would do is, as fast as you can, get your books in order with your CPA and apply for, the PPP program, and look for it and do it in a way that hopefully you can get your forgiveness of the loan. So in essence, it's a handout, and do that soon, because the government has capped the amount initially that it's going to be offered. Okay, I would call your current banking institution, see if they're in it. I would call up your community banks and be active there as well. In the meantime, you would just work on reducing the exposure to your current operating costs, the rent, utility, all that. See if you can push back paying your suppliers. And if you have any other questions, please reach out to Winston and the others, and we'd be happy to go specifically into your situation. So thank you.
Richard, thank you so much. This is a perfect handover into the next topic, which is basically cash for businesses. And when I say businesses, I'm talking about mostly small and medium-sized businesses, but that includes for-profit, non-profit, local, international, all of the above. I just want to try to focus, and we will leave part of that for next time, because we will have a longer session that would address the cash flows. I want to go through some of the numbers. I will start first by making a few comments on what Richard and what Greg had to say as they started. One of the things that they captured very well, and that are missed most of the times, is when we look for recovery and we look for fundamentals of recovery, and we look at stimulus packages such as this one, a lot of times people forget that US companies are operating globally. And to give you some examples of numbers, 44% of the sales for S&P companies are generated from global markets. And more than 50%, more than half of the revenue is generated by the fastest growing 50 companies on the market. The fastest growing companies are typically the ones that are more on the technology, high-tech, discovery side. Those are the ones that are seeing the highest growth rates year on year. And the top 50 of these are by far more than 50%. It's actually higher than 60% of their revenues coming from global markets. What that means is, when we take into consideration the impact and the recovery, I think it is always very important to understand that it's not only what the US government is doing in terms of package and stimulus, but it's also major markets such as China, Europe as a bloc, which is going through a very tough time medically, but also fiscally and economically. This is going to be one of the most challenging times they have gone through in recent history. The reason is, I mentioned that last time, and I will remind everyone of that, they have tapped into a lot of the resources and the tools they have to jumpstart the economy post 2008-9 crisis. If you look at interest rates, if you look at the cash that has been thrown in the economy, it exceeds by far anything that has been done in history. And this is a limited resource. This is not an unlimited resource. And tapping into that every now and then is not possible, or is not as easy as you might think. I said China, Europe, Japan, the oil producing countries as well. Look at oil prices and the revenues that are cut down, and what would that do to their consumption and to their spending as countries, as sovereign nations? If you segregate, or if you divide a lot of the regions, economic regions of the world, you would find that we are in a challenging spot, and that demand will suffer, no doubt, during the coming years. So what companies need to do with that, or what individuals need to do, is just to keep an eye on global markets as much as they are on local markets, and try to connect the dots between the two, because that gives everyone a much better and more complete perspective on things. Going back to our topic, cash flows. If you are a business, small and medium-sized business, mostly, what does it mean? Just some numbers to establish the facts. On average, small businesses in the US carry 27 cash buffer days. 25% of the companies, if you look at the left side of the graph, 25% of companies have less than 13 days of cash. And the majority, the 50%, are between 13 and 50 days. The majority of those, if you take the top 75%, have gone through all their cash reserves. And this is why Richard started by saying, I've heard that 25% of small and medium-sized companies are either shutting down or are subject to shut down or at risk of shutting down. This is the reason. The reason is the cash flow, the reserves they have, and the management of that challenge during times like that. I have it just, most businesses, as we said, as an established fact, have very little cash reserve. If you look at different businesses by industry, you find that mostly the labor-intensive, low-wage industries are suffering the most. This is restaurants, hotels, airlines, etc. And those are the industries, in fact, that we're seeing are suffering the most. Plus, they have the highest fixed cost that they have. So they have the highest fixed assets, basically, and fixed costs they have to pay for every month. And that's why they should be, by theory, the ones that have the highest cash reserve. But this is not the reality. Moving on, we have 28 to 30 million businesses that are classified as small businesses in the country. The majority of these have less than 20 employees, so are really on the smaller size. And around 40% of these generate less than $100,000 in revenue per year. Now, what does that mean? It means that this is the situation that they are going through, and the pressure on generating better funds, higher funds, and diversifying sources of revenue is getting more and more challenging during times like that. Just a quick classification by age. If you see, the majority, more than 50% of companies are younger than 10 years old. 33% of these are less than 5 years old. What that means is that they have not really reached the level of maturity and the processes in place to start getting more, like to be able to actively deal with such challenges, just based on the likeliness, at least. I want to share with you a quick slide, and this is, I took that as an example, but think of the restaurant industry as just one of so many. We talked about the airlines, we talked about the hotels, travel, cruise ships, everything that is driven by demand, physical demand, or physical physical connections between the supply and demand side of things. If you look at that curve, and this is for multiple countries and then with an average for the globe, you see that after basically March 15, or between March 15 and March 20th, everything went down from a positive down to zero. Restaurants, airlines, and multiple other industries that we mentioned that you can look into have gone practically down to zero. This is not in the US, this is globally. And what that means is that these businesses don't have any source of revenue unless they pivot and rethink of their strategies. You think of delivery as an option for restaurants, but every one of the industries might have some additional buckets to tap into, and this is up to each one of them to strategize and look at potential solutions. This is something we're going to address in a couple of slides, and I'm just trying to look at the time. I think I want to try to wrap up within 5 minutes. The fact is, the small businesses are more vulnerable than large companies. This is a fact. Usually the overhead costs and the fixed costs take a bigger toll on smaller size companies, especially in their early years. As I showed, the majority of the companies are smaller and earlier startups, basically below 5 years and then below 10 years. How to address liquidity? I have a list of things that companies could do, but I rather spend some time just going through this one and then moving into takeaways, the key takeaways we have. What could businesses or business leaders do? Where do you look into? I tried to make it as simple as possible and follow a couple of, basically the structure, the typical financial structure of an income statement and the balance sheet, to make it as simple as possible for everyone. Look at the revenues, look at your pricing, look at your offerings, look at how you're packaging some of your offerings. We just gave the example of on-site restaurant visitors versus delivery. Can you pivot quick enough? But that applies also to technology, depending on the sectors you're serving, depending on the industries you deal with. If you are in education or in healthcare, how can you very quickly innovate and move into more virtual operations? How do you address the team challenges? So looking at the pricing and the offering is one thing, the sales channels, etc. Can you accelerate some of the receivables and the collections from clients? Is that something that could generate a quick cash inflow into the company and expand basically the runway of risk that you're going through as a company? How do you manage the operating costs? Basically look at your variable costs, renegotiate payment terms, reduce return or return some of the inventory. Look at outside services, rent, salaries. Salaries really is something you would want to touch last, and you do it with the purpose of saving everyone else. That's the only reason you should be looking into that, because every time you're looking into a salary to cut, you're looking at a life basically and the family that is going through the same thing as you are. So unless this is absolutely pressing, usually you touch that final, like that would be the last thing you look into. And the last area you address. Financing costs. Can you restructure some of the repayments you have, the interest, the lease payments? How do you do that? Those are areas that we will dive into in more detail next week. Think of this as just a teaser for next week. But taxes, can you delay some of the payments? Obviously you can delay immediately. The answer is July instead of April. That's the first quick question. Richard addressed some of the aspects of drawing down on your retirement accounts and how to look at that and how to avoid paying taxes immediately on that potentially. Then when you look at some of the assets, are there any assets within the business or within the company, organization, whatever the type is, that could be liquidated? How do you look at, obviously, property, plant, and equipment? What other assets do you have? What business units you might have that could be liquidated? Even if you give away a little bit of the value in the short term, I think saving the company and ensuring sustainability is the top priority. Last week, we said that cash flow management takes precedence over growth and margins at this point. We gave the example of Uber. And this is still very valid. I think managing the sustainability of the business is the most important thing we are going through at the moment. On the investing activities, maybe issuance of new shares, talk to your investors, see if they have any appetite to invest in times like that for issuing new shares, maybe eliminating some of the CapEx that you had lined up even if those mean projects or spendings that you had budgeted for, how can you reallocate or reappropriate some of these resources? Maybe suspend some of the repos, share repurchase, basically activities that you had planned, any dividends distribution. If you notice, some of the global regulators are looking in depth into forcing dividend distribution, companies to stop dividend distribution. This is obviously starting in Europe as of now, and this is expected to go beyond that to the rest of the world, to try and maintain as high of a liquidity during the times we're going through. Financing activities, obviously, maybe early draw down some lines of credits you might have, talk to your bank, see what's the possibility, just to keep it in reserve, because if you have it at the moment, you can always return it. If you don't have it, it might be a challenge to get it in the future. If you have existing debt, leases, interest payments, maybe this is a good time to restructure or to renegotiate some of these. And the banks are always open to renegotiate in times like that, because they rather get the money in the future than to never get it if something bad goes for the business. So this is not something unseen. This is something very natural when you go through unexpected times like that. It is very acceptable and normal to talk to your bankers and to your financiers. I'm going to stop here. I'm going to keep the key takeaways for next time, because we're going to dive into more details, and I will get it back to Dina and the team to see if we have questions and go through final comments.
Thank you so much, Amr. So does anyone have questions or comments that you want to add in? I know I have some, and I can throw those out there if we don't have any from the group. Okay, so one of the things that we heard earlier from Richard, right, was that there's some estimates of a quarter of small businesses having shut down, at least temporarily already. So what would you say for those like B2B companies that really rely on like cold calling, networking? What's the best piece of advice to keep a sales pipeline from drying up and to keep some cash flow coming in right now?
I'll defer to Amir on that, potentially. Amir?
Yeah, sorry, your voice cut off in the last piece, and I was trying to unmute.
Oh, I just wanted to say I was going to defer to you on what businesses could do right now.
Okay, so other than going through basically the list of that we just went through to look into different pockets of liquidity to manage the process, I think as a business, I'm going to go to the takeaways. I said we won't do it, but this is the answer, is right there. I think one is you need to consider reallocating resources to the highest value aspects of the business. So if you have people in sales and sales are on hold, reappropriating some of these resources, this is the time to do it. To make decisions like that doesn't happen out of the blue. I think you need to have cross-functional task forces that address this on a day-to-day basis. They are meeting every day, they are talking every day, they're looking at the changes, and they're coming up with solutions as businesses. And this is not a top-down approach. This is something that is a collective, collaborative effort that needs to happen across the organization to come up with as complete of a view as possible. The reallocation of the resources and the people could be done from sales into development of strategy for the recovery piece, period. It could be acceleration of product development or shifting, accelerating innovation to pivot and address an unmet need from the market. Those can vary depending on each industry and each company, but those are things that change a lot of the positioning of every one of those SMEs, and they changed basically the recovery process for the future. Definitely over communicate. Communicating is not only to your employees, but communicate with your clients, with your suppliers, with your investors, with everybody that has anything to do with the company. Over communicating in times like that is more important than under communicating. It takes you a much longer way. Don't be afraid of saying too much. People want to hear and want clarity. The more clarity you can give, the less room for ambiguity and for speculation you leave. Obviously, leverage as much technology as possible to coordinate the efforts and the communications, and start planning for the recovery. Yes, we are going through a very hard time, but recovery is ultimately happening, like every time we've seen. You need to be ready for that. And the world is not going to look the same. A lot of sectors could be changed forever. A lot of sectors could look very different in terms of the offering, in terms of the delivery mechanisms, the product and the service packaging. A lot of these could change when the recovery starts happening. You need to be ready as a business, as a non-profit, as a for-profit, as a startup, whatever that is the case, you need to be ready for that time. During crises, you still have opportunities. We're looking at opportunities every single day in education, in healthcare, and so many other sectors. Look for opportunity. It doesn't help to just go through the drama every day with the team. Look for opportunity and look for ways to pivot and to take advantage of some of what's happening in the market. And as I said earlier, try to accelerate as much as possible the speed of innovation during times like that. Look at process workflows, look at strategy, look at governance, and seek expert help as much as possible. There's a lot of help available, and ask for that help. Tap into the resources that you have access to.
Yes, Amir, I just want to add quickly, we in this time, and I think you see leverage new opportunities. I think employees have really stepped up, and I think we can find new efficiencies in businesses going forward. So while we're dealing with just maintaining our continuity of business, I think it's great to get a lesson on where you can now see efficiencies and how you can pivot going forward. So I agree wholeheartedly with you.
That's very true. Yeah, thank you.
Okay, so then one other one that I wanted to add in while we have, these expert minds on the line right here. For people who have, so companies are, one thing, but then also just for individuals, when you've seen like stocks tank, maybe your 401k drop dramatically, and we looked at some of the slides earlier about previous recession periods, how long it's taken to recover. What is probably your best piece of advice right now to someone who has seen that drop? They're unsure about what's going to happen, not sure what they should be doing. What would you recommend or say to those people?
This is Greg. I'll take a stab at that. I'm glad that you prefaced your question when talking about 401ks, IRAs. So what I would read into that is that it's the appropriate long-term time frame. And I think the advice is actually very simple. It's don't do anything at this point. The downturn, the worst part of the downturn hopefully has already occurred. The biggest risk, particularly with longer term money, like retirement accounts, at this point, the biggest risk, frankly, is to de-risk. It's to shrink your equity allocation because that would just extend how many years it would take to recover the downturn. If you go from a heavy equity allocation to now a heavy fixed income allocation, bonds are not going to return as much in the recovery as stocks will. And so you would be digging out of whatever hole you find yourself in at this point with a lower returning asset class. So by and large, the best advice at this point is to essentially do nothing. It's not to monkey with that asset allocation.
Okay, and then one other I wanted to add in, because I'm, so many thoughts, right, that go through when you're experiencing something like this. One of the things that I've wondered is whether we're going to see something like this become more cyclical. So I know, right, we see ups and downs in the markets, we see periods of recession, but having something like this where we're going through social distancing, partial closures or full closures, do we think that's going to become more cyclical in a more rapid pace, I'm thinking? And then are we going to see more, do you think we're going to see greater precautions in the workplace, in the community during flu seasons? Are some of these things going to start happening on a more frequent basis, do you think? Just wondering your kind of initial thoughts given the period we're going through right now.
Well, it's just total conjecture on our part, but yes, based on everything that we're reading, this looks to be one of those sort of paradigms, right? The world is going to change and the country is going to change, society is going to change going forward in ways that we think we have a pretty good idea, but also in ways that we don't even realize at this point. And it seems a pretty safe bet at this point that how we all act in public and how comfortable we will all be to just sort of blithely walk onto that plane and sit elbow to elbow is going to be, it's going to be different going forward. And so that would be, I think, an educated guess at this point that this is going to influence for some time how people act and how that influences society going forward is going to be fascinating to watch. But it's just typical human behavior. It's going to take a while to climb out of this. I think there were some aspects of how we spend our time and, wanting to get out of the house and get back out once we feel comfortable doing that. I think that's going to be unnatural, but how we interact with each other once we're out in public, I think it's going to be different.
Yeah, I just want to add a couple of notes on that. I think the first thing that will be disrupted and re-evaluated at least is global policy and global interconnectedness. One of the things that we notice is the top 20 spending countries in the world have allocated massive portions of their budgets to defense. And defense has been at the core of the conversations in the past few weeks that we are ready to protect militarily, but we're not ready for an event like that. So I think the allocation of budgets and lessons learned from everything that's going on, basically losing in 2 weeks more people in the world than probably the past 30, 40 years in wars, is something that will have governments look back and start to reevaluate what's going on and how do we approach the future differently. The second point, which is we will have a lot of breakthroughs within industries and a lot of disruptions that are driven basically by an acceleration of digital transformation that needed to happen, that had not happened because some industries were lacking behind or lagging behind on innovation, and that today the door was opened, and once you're in and you started getting comfortable with that, it's very hard to go back, especially if you drive that growth from the demand side. People like it and want to see more. The third piece that I would say on the lessons learned is I'm seeing so much information that's very valid and very specific on how the planet is kind of healing itself during those few weeks of stopping, and what does that mean for the pollution and energy consumption going forward? How does that shift the investment in alternative energies and in alternative sectors that has been accelerating over the years? But I think this is a main breakthrough time where those conversations will be elevated to a different level.
Yeah, I think that's an excellent point. Something that I've been thinking a lot as you see these videos of sea turtles, reclaiming beaches that were occupied by humans. It's going to be interesting to see how that changes us moving forward. So with that, I haven't seen any additional questions come in the chat. So we're going to do this again. We're going to start doing these weekly check-ins, and we'll have a slightly different, topic focus from week to week. But our next one will be this next Monday, 11 Central Time. I'd love to do just a huge thank you to Amr and Greg and Richard and Winston for spending their time with us today. This was really excellent. We're all trying to navigate this together and get through it in the best way we possibly can, and staying connected and talking to people who have expert knowledge in this space is the way we're going to accomplish all of that together. So thank you so much, Richard, Greg, Winston, and Amr, and we will talk again next week. Thank you so much, everyone.
Thank you, Dina. Thanks, everyone.
Awesome. Thank you.
Thank you so much. That was great. Thank you.